Well, good morning, everyone. Another Friday rolls around, and here we are, the four Amigos, and we're going to have Ed take us through a little bit of a financial roadmap here to help us better understand how we can optimize our business wealth and move forward in that way. So, with that, I'm going to pass it on to Ed, and Ed, guide us into how we can create more wealth, particularly for younger people coming along.
Well, good morning, and thanks for the introduction, Ray. Today, we're going to talk about the value of a financial roadmap and how we can optimize the business results as well as create more wealth. So it seems like a pretty interesting subject when you look at it from that perspective. I'll start off with the question we talked about many times before. How many people really know the value of their business? And second of all, how can you value and manage your business without a plan? How do you know if you're going to be successful without a plan? So those are the two big questions that we'll be talking about today. And it gets down to the million-dollar question. I got a lot of questions today on this presentation, but the million-dollar question is this. Why don't more business owners know the value of their business compared to every other investment that they have? If you have investments in stocks or bonds or real estate, you kind of know how much money you make every year from those investments. But even though the business is one of the biggest assets on many balance sheets, they don't know the value. And I find that interesting. And it doesn't seem anybody's really interested a lot of times in knowing the value of their business. So any comments about these topics, these questions so far, John?
I do have a comment on knowing the value of a business. One of the things, when I was first in business, I didn't know how to value the business because frankly, it was like a house. If the analogy is a house, I bought the land, I had the design, and I was building a house. And in the middle of building a house, you're not really sure what that house is worth. What I hope is what the business will be worth when it's built and when it's running, and it will be some kind of a ratio of income or profit that I've gotten. So I'm kind of hoping for that. But in the meantime, I'm bleeding money and I'm not making any money. And I'm suspicious of the fact that actually right now, my business is worth nothing because I'm not getting paid very much. And I'm spending more money to get it going. So maybe one of my things is a lot of small businesses are in this period of time where they haven't quite got themselves established. Now, as for the established businesses, I think that's a bit of a cop-out because they should know at that point, what their debt to equity is, how much they can leverage. I think that should be every few months you should go through kind of a where are we and what's going on. So I do agree with you on that. I think it's difficult in the front end though.
I would say that the answer to the big question there is that that's not why people go into business. They go into business because they want to run their own show, because they don't want a boss, because they have a dream to build something, or they figured out a problem that they want to solve. And so if you're single-minded enough to where you're going to jump into something and give it everything you've got, it's not about value for some time, years later, to that person. And then the other side of it is they may have had some stocks, some bonds, and many of them own a home. They're using the home as the way that they're getting a loan, and they've cashed in their stocks and bonds, and so there's no reason for them to really make a comparison there because they don't have any. And they've just plowed everything they can into their business if they really truly believe in it. And they just, they're out there without a life raft. They are there to make an idea work. And so I would say that's the reason. Until it begins to be successful, they've kind of replaced their job. In other words, if they were making $50,000 and they finally get to the point to where they can take $50,000 out of the business and maybe plow a little bit more cash into the business, then they start thinking about, oh, maybe I should save some money. I've got my 401k and I'm going to do those kinds of things. But it takes I'll say mature, but it doesn't have to be a mature business. It has to be one that has grown past initial startup, which was first 3, 4, 5 years, I would say, before they start thinking about, it looks like I'm going to be successful. I'm not going to lose my house. And therefore, I can start thinking about this. So that's kind of the sort of summary of working with, dozens and dozens and dozens of these kind of small businesses over the last 40 years.
And I'd like to piggyback on what Ron just said. I think the other thing is we know 80% of these small businesses, and when I talk about that, that's typically somebody with less than 5 employees. Their goal is to ride it out until they're gone. I mean, either through death or through retirement or whatever. They have really no interest in it beyond that. And I think even Ed, didn't you tell us one time you had a client whose business was worth $2 million and he didn't want to sell it?
Yes, it happens all the time.
Yeah.
And Ron's mentioned that many times before too.
Mm.
And I think another factor and we'll talk more about this as we get through the presentation, but another factor is that we all think we're going to live forever. So we've been in business for 20 years. We think we're guaranteed another 20 years to move the business forward. So we don't think about transitions.
Yeah. There's a tendency to you've got risk takers, and there's a tendency to take a look at the risk of dying, not nearly as seriously as maybe it really is. And then there's a tendency also not to evaluate what the value of that risk is. The risk of dying is one thing that's catastrophic, but what is the risk that dying will destroy all of the equity in your business? So, they don't tend to think about that.
No.
And just to kind of add back onto my earlier comment, I think that the point here, and I think that this is the point that you'll be making, is that even though that might be the reason people to go into business, that should not keep them from thinking about understanding the value of your business, and they'll be much further ahead if they do pay attention to what the value of their business is.
So to add on to that, I totally agree. I've got a case in point here with a company that I've worked with in the home supplies business that getting to the end of his age span of operating it, a family member got very, very sick. And he actually had somebody who wanted to buy the business, had previously made contact, and he just decided for ease of operation to close it down. And it was probably worth $1 million or so as it was, but as part of that process, there's some land and there's some buildings associated to it. He was prepared to negotiate over $20,000 worth of difference in land cost or property cost, but was prepared to let go of $1 million worth of business value. And so I find it interesting, but maybe it's not interesting. Back to your point, Ron, the reason people go into business in the beginning is not for the money.
Yes.
And at some point, this individual said, I don't know how to do this really well, and it sounds complicated, therefore I'm not going to do it. That's a loss. I do know how to negotiate over land or property, so I will do that.
Yeah.
And I think the sadness is, in reality, one of us should have bellied up and said, I'll tell you what, I'll take 50%. You're not going to sell your business. I'll take 50% of it. I'll do everything and sell it for you.
Yeah.
It'd be a heck of a deal for him.
Oh, I think that's a great business model. We've talked about that in the past. You find those opportunities and take advantage of it. There's a real model there for me.
Yeah. Yeah.
Well, and people say you're taking advantage of the guy, and at some point you're not. This particular individual was more worried about the health of his family members and himself than he was about you just go do it. I just want to be done.
Yeah.
Right. Yeah. Good point. Missed opportunity, John.
Yeah.
Well, maybe, except you feel a little bit like you're coming along like a symbiotic relationship, and
You
it's
mean
a
a
very
parasite?
yeah. Thank you, Ray. But you do feel a little bit like you see the opportunity, and they're overwhelmed.
Well, I
Yeah.
can throw in a story. I don't know if this will be congruent with where you're going, Ed, but in a situation like that, I've heard of a time or two when there have been folks who've come along and said that, and then the response of the owner was, "Are you crazy? 50%? There's no way I would do that. I'd rather sell it for book value than that." And then so what happens, or if they enter into it, what they could do, depending on the type of business. But there are a lot of businesses that spend quite a bit of money on marketing. So what they do is they simply begin to ramp down, and they stop spending the marketing money, and they put that money in the bank. And as they're shutting down, their profit doubles or triples. And so they end up getting their money out of a business that they're winding down because they're cutting costs, and they're not spending any marketing dollars, don't have any salespeople. They're just waiting for the business to naturally wind down. And they end up with a lot of money. In one particular case, a business that I'm familiar with actually did exactly that. And because their marketing costs were a very, very large number, they were able to put $300,000-$400,000 to the bottom line in the last 2 years of operation that they would not have previously had. And they just said, there it is, that's it. Now I'm going to sell my equipment. I'm firing my employees, sell my equipment, and I'm done. And I didn't have to pay you half of the value of what the business would have been. So there's more than one way to skin that cat.
Okay, well, moving along. When I meet with a new client, I ask 5 questions. Number 1, do you have a forward-looking strategic plan for creating value? How do you get where you want to be without a plan? That's number 1. Well, you can imagine most people say no, right? Number 2, do you measure the value that you've created annually and reward your team for performance? Well, if number 1 is no, number 2 is going to be no. Number 3, how can you manage, reward, and hold others accountable without a report card on performance? And the way you get a report card, you have to compare against a forecasted number, a forecasted plan where you want to be. Number 4, do you know what your company is worth? Well, we all know the answer there. It's based on present value of future cash flows. We were in a meeting just this week where someone who has got a company that has negative cash flow was asking me to value the company. And I said, well, the value of the company would be the liquidation price, or if you could find a strategic buyer that would be willing to pay above and beyond for certain assets that you have beyond your cash flow, there might be a value. But you got to have cash flow most of the time to have a value of your business. And then the last question I always ask, do you have any understanding of what risk you're facing and how to reduce them? Because if you can reduce your risk, you're going to increase the value of your business. So anyway, if you score 4 no's, we probably need to work on a financial roadmap. Any points there, folks, before I go on to the next question?
Good job.
Okay, why is it essential to have a forward-looking financial roadmap for optimizing the business? Well, we talked about it, shows where the company is going. It's a comprehensive, measurable, objective method for evaluating the future. It focuses on cash flow, and we've been talking about that's the lifeblood of any business. Inadequate cash flow is a major reason for business failures. And business really doesn't have a value if it doesn't have positive cash flows, which we just talked about. It offers a sophisticated approach to valuing the business. It's a report card for holding others accountable and rewarding them. It establishes boundaries for planned spending, necessary investment, and performance goals. And it identifies and measures operating risk. Okay, so the next step is, how do you create one? And this is where you need to get help most of the time, because really the expertise and the skill sets for preparing one of these is normally not in a business. And it just creates, when you try to do this with people that don't have experience in doing this, it creates a lot of frustration in the process. But it starts with, you really have to understand your income statements, your balance sheets, your cash flow statements. And I recently added owner's equity, because a lot of times people don't realize that they have an equity in a company. It's not 100%. If you have 4 or 5 different owners, they all have a different percentage. So I added that in there. Here's 2 from Ron that I've learned. Are you meeting the expectations of your customers? Can they operate without you? That's really, really big, because remember, the value of a business is future cash flows. And you start losing your customer base because they're not happy. That's not a good thing. And the other item that we talk about in many of our previous conversations, and that is, are we fully leveraging our competitive advantage? What do we do well, and how can we continue to exploit that asset that we have? Beyond that, you have to have, in my opinion, a strategic plan of the future. And it basically, I like to do is a base case, business as usual. Where are we going to be tracking for the next 5 years if we do just what we've been doing? And then I like to come up with a value case. If we're going to do 5 different initiatives, how is it going to increase the value of those future earnings? And the difference between those 2 cases identifies the value you're actually realizing for the company. And we're going to talk about the 8 drivers. It's been a while, but the 8 drivers that we've talked about in the past, they do add value, and they have to be built into the strategic planning process. For instance, Ray and I did this for a company, and it really paid a lot of dividends and put them in a different classification altogether. It really made a difference. Even though everybody was reluctant to get started in that process, at the end, they were all very happy that we did it, and they all took ownership and moved the company forward. You got to have forecasts, and that's not easy for most accountants in particular, or business operators, to do. But you have to forecast the future with numbers, and then every quarter you compare where you're at compared to what you forecasted, and then you make adjustments. And that's how that's how you fine-tune your strategic plan and your forecast for the future. And you want to inspire your team to buy into these numbers, and then hold them accountable for planned results, and obviously adjust quarterly as needed, and hold people accountable. And one example that Ray and I did when we started having, after we did the strategic plan and started having quarterly meetings, most people came in the first meeting, and guess what they did? Nothing. So they got scolded, and we got everybody back on the plan again. And then the second meeting we had, the second quarter, about half participated. By the end of the first year, everybody was doing what they were supposed to do. But if you didn't have this process, you couldn't hold them accountable for results. We talked about the 8 drivers many times before, but I think it's always good to review them and to make sure everybody's looking at the value of all these potential drivers for improving the business. And the first one in the box up in the upper right is, the top is market potential and competitive advantage. And then we move down in the circle here, and then you come up with your stickiness of customers, which means, are your customers happy? Happy customers don't leave. Then we go to 3, exploit competitive advantages and grow revenue and margin. Obviously, if you grow revenue and the margin is going down the drain, that is not what you want to do. You got to look at both. The 4th circle is people and systems for efficiency, quality, and method of delivery, meeting the expectations of the customers. The 5th circle is invest in high ROI projects that return superior results, which means you're further investing in the company. And the 6th one is optimize the balance sheet and cash flows, because most people focus on income statements and not the balance sheet. But when you really determine the value of a company, it's based upon the value sheet, the balance sheet, and the cash flows as both. And then number 7, which is always an interesting one because nobody is basically doing this, but looking outside of your company, looking for M&A opportunities and potential partnerships to add further value. And last, but just as important, is reevaluate and reforecast. So why aren't more family businesses using a financial roadmap? And you guys are going to be able to provide some good insights here, and reaffirm some of these points I'm going to make. First of all, we're not trained to value businesses like we are other investments in our portfolio. We just don't think that way. We don't have really the expertise in the business to do this kind of planning. We're lucky to have a controller who can report the results of the past properly, let alone looking at the future. We're not focused on selling the business. Some owners might not even sell. It's not a issue to them because they think they're going to be in that position forever. They're not going to leave this world. And so they don't have to think about the next transition. At least that's the way they think. Another indicator is they work in the business rather than on the business. They're so busy meeting daily expectations, they can't think outside the box. It's really amazing. Wealth management advisors don't always look at the value of the business. And I find that interesting. I wrote to one just this week, and he said, I said, don't you want to educate your clients on this? And he says, well, we're covered. His business is covered. We know what it's valued, and we got a transition plan. My point was, what about all the clients that he's advising? So again, it's not a big issue to the trusted advisors that business owners use. And they focus primarily on past performance. Tax avoidance is number one. That is the biggest issue to a business owner. So that's where they focus. They focus more on the income statement. Most don't really understand the balance sheet. And the forecasting is not a skill of a CPA or trusted advisors. They just don't want to do it. And more importantly, they see all this risk of trying to forecast numbers. They're afraid of it. CPAs are trained to be technicians and do things very well on past information, but it's not the same when it comes to forecasting the future. That's where the CFOs of companies have to focus on to add value to their companies. And obviously we come across the normal response. Things are just fine. Why change? And I think the biggest issue we're dealing with all business owners, they just don't know what they don't know because it's not their expertise. And then there's poor communication and expectations between ownership and management. Can't think outside the box of different scenarios. They're just not used to running those types of numbers and thinking that way. And just not accepted as an ongoing management process. It's just not part of their nature. So what do you guys think about this? A lot of these points were discussed by you guys earlier in the presentation. Is there anything you'd like to add to it?
Yeah, I'll make a few comments about forecasting, which I had on the previous slide as well. You're so right. Family businesses don't do forecasting. They don't know how to do forecasting, and neither CPAs. They want to stay away from forecasting with a 10-foot pole. And so then you kind of say, oh, well, where do you go? And I would say, when you're talking to management consultants, there are a few that can do a spreadsheet and begin to fill out some revenue for forecasting, but it's generally extremely pathetic, and of course it depends on the circumstance. John and I are working now with a MicroGiants member and we're working on a forecast so that he can raise some money. The problem is it's a brand new business and it's a brand new segment of an old business, and that segment is unknown. We don't know how big the niche might be, et cetera, et cetera. We have some ideas on how big the general industry is, but the question is, well, how in the world do you actually do any forecasting? There have to be some drivers for forecasting for it to be any good. So what we're doing is we're putting together some sort of benchmark numbers so that we can build what would be a sort of a budget along with the forecast, but it has to do with meeting expectations. What's our break even? What's our full sell out of the first, say, order of products? What kind of increments can we have over and above that? You just pick a number, 250,000, a million, or whatever, do 3 or 4 more. That's about all you can do on that. But the key to forecasting, and I should probably do a whole program on this, really. The key to forecasting is finding the drivers. Those drivers, very much like your 8 drivers for business, there are, 6 or 8 possible drivers for forecasting. So I'll give you an example. For people who try to forecast, have tried to forecast the sales of a specialty store, you've got your sales from the past, so that's your first level, and you're doing X amount of dollars. And so people will just take that and they'll go, okay, well, we did $1 million last year, and inflation, well, and therefore we'll just plan it up 3.5%. Well, inflation is actually 6%, so let's plan it up 6%. Okay, well, that's no growth at all. And they go, okay, well, we'll add another 3. So now we're going to plan it up 9%. So what have you done there? What you've done is you build drivers to do nothing but increase your expenses, because your sales costs are going to be tied to what your expenses are, instead of your sales expenses pushing your forecast. So you end up with a budget that's wrong, number one. And number two, it's probably wrong because nobody can forecast based on averages. And the revenue of a store is based on averages of the categories of merchandise that are sold. Most very small specialty stores have as many as 15 or 20 different categories of merchandise that have their own fluctuations. They fluctuate on 2 or 3 things. One is whether or not the market is growing, whether or not you did a good buy, and they have their own seasonality. You don't sell a lot of swimsuits in the middle of the winter, and you don't sell very many swimsuits in Alaska at any point. And so the geography has something to do with it. Therefore, you have to take into account all of these variables in order to get anything close to a real forecast. But here's kind of the point. You can do all of that to your heart's content and build a very complicated spreadsheet and come up with those numbers. But there's one thing in this example, a retail store, that if you don't have, you will never meet the plan. Anybody know what that is? It's inventory. If you don't have the proper inventory for the proper category that you're forecasting, you will miss the plan. Number one. Number two, if you have too much inventory for that season and that category, you will have too many markdowns because you bought too much, and therefore you will miss the margin plan. In both cases, you've hurt yourself. You either haven't got the revenue at all, or your margin is so bad you wish that you hadn't bought it. Having no revenue would have been cheaper than the other way around. And so there are all of these issues you see, and there are 6 or 7 of them that I can think of off the top of my head that will drive sales. But the business has to know and understand what those drivers are. And I know another business where the drivers of revenue are directly related to how many salespeople there are. Why? Because there are enough salespeople where you can take a look at averages. You see how many times they're out on the road, how many calls they make. You calculate what their close ratio is, and you find what the drivers are. And so therefore we can get very, very close on our forecast for that particular business because we understand the drivers. Whatever they sell, we make. So that, so long as we have enough raw material, we're going to be able to hit those sales plans. So it's very, very complicated. And asking a small business to try and do this accurately is nearly impossible. And unless it's a real simple business with like 1 or 2 products, asking advisors to do it is very, very difficult. So that's a tough thing to overcome, is to get a forecast that actually works.
Very good. Well, as you can see, the last slide here is steps for moving forward, and the last item should really be the first item. It's the item that you mentioned, and that is you got to get help, because most of the time you don't have the expertise in your company to do these types of changes. They're just not used to doing it. You ask a controller to do a forecast who's never done a forecast, it's a challenging thing. They don't understand what you're trying to accomplish. So you have to get help from the outside to make some of these things happen. But I guess just quickly going down the list here is steps for moving forward. Accurate and timely financial information is a must. Prepare a strategic plan supported by a SWOT analysis, which we've talked about is important. Optimize your competitive advantage. Keep your customers happy. Focus on the future. Forward-thinking modeling with forecasted numbers. Compare performance to last year, last month, and to forecast.
Let me interrupt you on that one, Ed.
Sure.
This is the remedy here to the problem that I just pushed forward on there, and that is that you need to do the forecast anyway, and knowing it's not going to be very good. But if in fact you always come back and you make comparisons and corrections, you have a tendency to teach yourself how to do a better job.
That's right. You learn from it.
It's not just at the sales level. You have to also do it on several of the other levels too. Number of salespeople, how your inventory, et cetera, et cetera. It's fairly complex, but this is how you can learn to do it, is by that particular step.
Yes, absolutely. Which means it ties right into understanding any type of variances you have, cause the variances.
Mm-hmm.
From that you come up with better projections for the future, and you can improve performance also. Are we making progress? Are we meeting quarterly to review? That's something that it's got to be part of the process, and very few companies can focus on this. It's regimented. It's a way of growing value, and you have to do it every quarter. You can't skip. And a lot of companies, they get excited about something, do it for a while, and then they stop. And you're just wasting a bunch of money by going that approach. I like to value the company annually. I have models to do that, so you can determine whether you're creating any value. And if you can reward your team for creating value, you're going to get a performance company culture going. And obviously get help if needed. Most people need it. They don't even understand what we're talking about here a lot of times because they're only focused on the past. So that concludes my presentation. Any other feedback from you guys? What you think could make this more effective?
I appreciate you doing this, and I think it's of merit for us to kind of follow up and remind people again of how they can do this and what we can do to help them create a forecast that's meaningful.
Absolutely.
I would say that you kind of hit on something there that is a reminder for everybody who's a small business person, and that is that the consistency is terribly important here. It requires a level of detail that a lot of business owners don't enjoy, and they many times have people who are good at detail level in, say, the bookkeeping or accounting department. Sometimes it's another department, but people who are, very, very detail oriented, and they love process, they love completion of a task. That's typically not an entrepreneur. And an entrepreneur, therefore, is very, very tough. And we, all four of us, have experienced this. Very, very tough to keep them focused on doing all of these things, even with us in the room. And so the issue there is, well, what is it about the personality, the mentality of members, say, of a family who might have diverse personalities and diverse talents? What does it take in order to keep them on track to do all of the things that will help them be successful? That's probably fodder for another meeting. But I find it to be the number one problem is really that the people who create the excitement in the business are almost never the same people who can do this. And if you can't keep them interested in are we making any progress in going through and having a full day board meeting, one detail after another detail, after another detail, after another detail. If you can't get them to do that, you're going to have a hard problem. And I would say that I can count out of dozens and dozens and dozens, or maybe hundreds, I can count the number of entrepreneurs who would suffer through this on one hand. I'm talking about a full day quarterly meeting where every single number is studied, compared, reviewed, and put into place.
I agree with you, Ron. I think if I can, where Ed and I were able to do this successfully, and I give all the credit to Ed for that. He was the one that helped them put together the strategic plan. And really, at his point, the first time, we went through it, there was no interest. But as we move forward, people began to see there was a direct correlation between what they were doing and the numbers they were getting. And so it went from being either a chore or a problem to kind of a fun thing to see if they were making progress, and I think that's the fun thing about having a good forecast. And as we've been talking about here is reviewing it regularly so that people know whether they're making it or not. And once people get into it, it can be a lot of fun and very profitable. Well,
it is effective, and I'm just suggesting that it's awfully difficult to.
Oh, absolutely, yeah.
Absolutely.
And my comment to those who are entrepreneurs who are watching this is, you may think it's not worthwhile, and you may find it boring, and you need to just say to yourself, tough, I'm going to endure this meeting. I'm going to get through it. We're going to stay on track. We're going to follow the schedule because I know it's good for me. It's sort of like, I don't know, vitamins or eating broccoli or something like that.
It's exercise.
Yeah. It's like, come on, it needs to happen.
Yeah.
Because I want to add to that too. I think part of that is just the reality of the fact I've got a little file folder that I call W, worst case scenario. Mm-hmm. And in the worst case scenario, I have put in certain plans and ideas that will help facilitate either I am killed or I am, which in some sense is the easiest way, because I'm going to look at it. But what about if I'm just incapacitated? So I'm physically incapacitated, but I'm still mentally active. Well, what about the flip side? I'm mentally incapacitated. So I put that in, and then I realized this actually is freedom. And once you embrace this possibility of tomorrow thinking and the ability to work through it, it actually is freedom, because you'll discover there is some value in the people and in the plant and in the where you're at that is actually a little bit bigger than what you thought. And you might even find that there's a couple of problems that you can easily forestall now and make advantage of it later. So I would highly recommend it as being a very necessary, I don't want to say evil, but a very necessary discipline.
Yes.
We should all do.
Yeah.
And we don't want to face it. We want to think, well, we've got control. And to some extent, it's a little egocentric. I think
Very much so, yeah. And I like your comment about freedom, because
it is freeing once you do it. And I'm in the middle of redoing it, and I don't like it, but I've got to do it.
And I've had businesses where if it was about making money and I wanted to free myself from the details, the risks, and et cetera, then it made sense and I could do that. But I've also had businesses where I just enjoyed doing it. And it's like, forget it. I'm not interested in all of the detail because I'm doing it for fun. And so I'm just doing the fun stuff. So, it really kind of depends on the mentality. Of course, the personnel, but the mentality of your ownership has to do with what are you trying to do? And if you're trying to give yourself a job, do something that's fun all day long, or just do whatever the heck you want to do because you don't want anybody to control you, chances are you're not going to be a person who's going to make a lot of money, because you must pay attention to all of these things that Ed has laid out here in order to be able to optimize the money, the cash flow, the sales. It is so hard to stay in business today and so hard to make money. If you don't do these things, you're going to end up being one of the 95% of the people who never really make any money in business.
Oh, that go out of business.
Yeah. Well, yeah, I'm talking about go out of business or stay in business. If you're the 10, 15% who can stay in business, you still don't make more than, say, what you could make outside. So it's like you never really made any money. You just gave yourself a job. So, make a decision. Did you want to make money or not? And I think that's there. When I came to a point in some business along the way where it was, I'm really tired of all the things that I enjoy, and now I'm going to make some money, and my whole attitude about it completely switched.
So Ron, I want to challenge you here. I don't think it's about making money, and I think it's about being able to give away money. And I never used to do very much of that. Now I'm doing a little bit of it, but there is more joy in having made money and then giving it away for causes that are valuable to you. I got to really challenge you, because there are people who don't want to just, my goal is not to make money. That is like, that's capitalistic. That's just about making money. Yeah. What about changing the world a little bit? Yep. Let's make some money so we can help affect the good of the all. Now, I'm 100% on board for that.
I think they're the same thing. I mean, you have to make it in order to give it away.
But we need to challenge people. You can only help other people to the extent that you're able to help yourself, and you've got something over.
Oh, that's absolutely right. No, if you're gonna want to give it away, do something to help the community, whatever it might be. You got to make it first, and you also have to reinvest that money in the business in order to be able to get the volume to the point to where it'll make significant money, so that you can give away significant money.
So there's back from where I come from in New Zealand, making money was being highly profitable was not regarded necessarily as a extremely good thing.
I think there's a lot of that here.
However, having retained earnings and being a good steward of the resources you've been given was regarded as very good.
Yeah.
So when I did work with a large organization in New Zealand, and the whole pitch was, let us make sure we have a very strong stewardship foundation and our retained earnings are as strong as they can be. Everybody loved it. Yeah. If we said, we're going to make as much profit as we can, that would have been automatically negative. Mm-hmm. So choice of the words here, I think, is important. And I think also use of the money. The only reason we want money is that we can help other people and help ourselves. Mm-hmm. I mean, that's what it's about.
Yeah.
Yeah, I think somebody once told me that money is kind of like manure. The only time it does any good is when you spread it around to make things grow.
That's a good one. I think that's a good point on terminating this
Yeah,
conversation.
that's right.
You can't top that. Well, thank you, gentlemen, for your feedback. This was very helpful to me in getting your points of view, and I'm going to revise this accordingly a little bit differently, but thank you so much. And for those outside listening, take a look at this and look at developing a financial roadmap. I think you're going to be pleased with the results.
All right. Very good. We'll see you.